it's interesting. We're still 3 weeks out from the next policy meeting, but we've seen this jump when it comes to what the market is expecting. I want to bring up this function on the Bloomberg, WIRP Go, which really tracks these interest rate expectations. You see, we've gone up to close to 40% in terms of what Fed Fund Futures is pricing in for a move in the next March meeting. Would you be comfortable with a move in March? I mean, I know the talk is always sort of data dependent. What would you need to see between now and then for you to be comfortable with a hike next month?
Yeah, so my own view is that if the economy continues progressing along the forecast that I've been saying, and I think the data has come in consistent with that forecast, I'd be comfortable with rates being higher than they're going to be. But, no one's thinking that we precipitously have to raise rates. If you look at the summary of economic projections, the last version of them in December, we're going to get another set in March. It's a gradual upward path in interest rates, and that's consistent with where we are progressing on our goals. So in my view, we're basically at full employment from the standpoint of what monetary policy can do in labor markets. And inflation, it has been moving up toward our 2% goal. We're not there yet, but my forecast is that we're going to continue moving that up gradually over time. So I would be comfortable with interest rates moving up. But as I always say, I want to hear the discussion at the meeting. We're going to get data between now and the March meeting, and I like to hear the discussion at the meeting because different, participants are going to have different views of the economy.
Is there a concern that with both PCE core inflation as well as CPI inflation that we're seeing some sort of odd seasonality come through at this point? Is there an argument to suggest that, look, you might want to wait a little bit longer, particularly as the follow-through from the pickup in sentiment that we've seen since the election hasn't really played out yet?
So even despite the sentiment, if you just look at where we are relative to our goals, I think the economy is moving closer on the inflation. So again, I think I like to look at the medium run outlook and data, is the data coming in consistent with that outlook? And in my outlook, I have a gradual upward path of interest rates over time. The particular timing, one meeting to another, isn't that important from a macro perspective. But, you do have to say that we've been making a lot of progress. And you don't want to delay too long because then you will be behind. I don't believe we're behind the curve yet, but I do think that if we continue to make progress on our goals and keep delaying, then we would potentially get behind. And why is that important? It's important because we want the expansion to last. We don't want to do something that, if we delay too long and inflationary pressures do build up, we don't want to feel that we have to raise interest rates on a steep path that then could put at risk the expansion. So again, I think the gradual path actually ends up with a better outcome overall in terms of the length of the expansion.
How many rate hikes were you pricing in, or penciling in, I should say, back in December? And from then until now, have you been considering changing your dot or any other part of the quarterly projections going into that March meeting?
Yeah, so again, we're going to be going into the meeting and putting in new forecasts. My forecast is basically that growth is a bit above trend. My trend rate is about 2%, which is a bit higher than the median in the SEP. My inflation forecast has inflation moving up gradually back to 2% over the next year and a half. And my unemployment rate is below. My long-run unemployment rate is 5%, again, a little bit higher than the median, but I have unemployment rate going down from here. So again, that forecast, I think, is basically, similar to what I see going forward. There is uncertainty around all forecasts, and I think when you think about forecasting, there are a lot of things that can happen. Shocks can happen to the economy, and any economic forecast is going to have error bands around it. And what we want to do is sort of focus on the median path, but also understand there are risks. And I think that this is a particular time where there are some uncertainties about the fiscal side of the policy side of things. But, we build in what we can, and then we have to wait to see how things play out. Again, always keeping focused on our goals, dual mandate goals of price stability and maximum employment.
Yeah, I'd like to pick up on what you said. There is sort of an added layer of uncertainty, which is, what's going to come through from the new administration in terms of policy. I mean, are you uncomfortable, looking at why we've seen this rally in the stock market, for example? Has it happened because of the Trump election victory or in spite of it? And are you sort of uncomfortable making these assumptions in the absence of more details when it comes to, what the fiscal and economic policies are going to look like?
Right. So the devil is in the details on the fiscal policy. It's in terms of the timing of the impact, the size of the impact. So you're exactly right. There is uncertainty around that package. But we always have uncertainties out there. There are uncertainties, in the international economies. There's uncertainty about European banks. There's a lot of geopolitical uncertainties. But our job is to sort of, given the uncertainties, we still have to make a forecast and we still have to think about what's appropriate policy. I think in a particular environment like this, we might see more changes in our forecasts and the associated appropriate policy paths than we might have seen over the past couple of years. But I think that's good in the sense of we want policy to take into account economic conditions. We don't want, if the economy is changing and our forecasts are changing, right, we want to base policy on that revised outlook. So again, as some of that uncertainty becomes resolved, right, we will react in terms of our outlook if need be, and will then set policy appropriate given the outlook. I don't think just because there uncertainty means that we shouldn't be doing anything. I think we always have to be basing our policy on sound economic monetary policy principles and being systematic about how we react to incoming information. That's how I interpret data dependence. We want to be very systematic about looking at the data, assessing economic conditions, seeing whether we need to revise our forecast, and then setting policy consistent with our outlook. And that's how I go into the meetings. I want to look at all the data that comes in and then hear what my colleagues' views of the economy are, and that helps inform my policy view.
Is there a concern, though, with this sort of gradual, steady, data-dependent approach that you may get caught behind the curve, that inflation could get out of control, particularly as we have seen from the new president, that he has, rhetoric has translated into action. The things that he's promised, a great deal he has actually tried to put into policy in his first few weeks of the presidency. If he does make good on this massive infrastructure spending, fiscal spending plan, is that going to force the Fed to move more quickly? And are you going to get caught on the back foot?
So as I said, we're not behind the curve yet, in my opinion, but that's why we have to be willing to take into account the environment, and part of the environment is going to be what the fiscal package is going to look like. I don't really think, from a point of view of spurring aggregate demand, we need fiscal spending for that point. There are certain fiscal changes that actually could be productive in terms of raising productivity growth, and as you know, productivity growth in the U.S. has been quite weak for a number of years. And so if we could get packages that would help, for example, retrain workers who have lost their jobs because of globalization or technological change, allowing them to build up skills that the modern economy is looking for, I think those would be productive things. But those generally take quite a while to play out. So again, it's going to matter in terms of, what does the package look like? You're right. There is a lot of positive sentiment when you talk to businesses, and certainly the consumer sentiment surveys are positive. Early on, the positive sentiment hasn't really translated into action. There's beginning to be some signs in the businesses I talk to that they're actually starting to think like, okay, it's time to do some investing. So again, we'll just have to see how the economy plays out. We'll have to assess the package when we get more details about what those impacts will be. And we have to be kind of nimble about it in terms of being willing, right, to change our policy path if we think that the economy is evolving differently than we anticipate.
If you get the sort of steady as she goes pick up in indicators that we have been over the past few months, how many hikes would you be comfortable with this year?
So I've built in my forecast a bit stronger path than the median just because I see the economy as a bit stronger than the median path. But again, I think, when you think about that, if we put error bands around those forecasts, both growth, inflation, unemployment, and the policy path associated, you'd see that the error bands around those forecasts are much wider than this dispersion across participants on the FOMC. And that's just the nature of forecasting. The forecast errors around any economic forecast, not just the Fed's, but government forecasts and forecasts made by the private sector are pretty large. And that's just the nature of the art of economic forecasting. Shocks hit the economy. Things play out differently than you might anticipate in the beginning of the year. And we just have to be able to, accept that. We're in an environment, the economic state of the art models, which model is going to be the best predictor at any one point in time given economic conditions. We don't know that. And so we have to, again, not be put off by the uncertainty, but take it into account as part of the environment we live in and then set policy. So again, as I said at the beginning, if the economy continues on the path that it's been on and that I anticipate, I'd be comfortable with a higher interest rate.
Are you comfortable with where the jobs outlook is at the moment? Because I know, as here in Australia, the RBA has also been sort of battling these stronger headline numbers, but participation and that sluggish wage growth really being, pretty stuck where it is. Is that, I guess, as good as it gets when it comes to the US?
Well, wages have been moving up gradually. I think there's some part of the labor market conditions that are quite good. I mean, we've seen, economic employment growth in solid conditions. But remember that equilibrium employment growth is much lower than it was in the past, and that's reflecting of the demographics of the U.S. So again, there are some problem areas in the labor market. There are a lot of the technological changes, and not just from the Great Recession, but even before that. And the globalization, which if some jobs are not economical in the U.S., those things have changed our labor markets. And I think it behooves the country to think about what's the best way to train workers, educational programs, so that workers who've lost their jobs can transition into jobs that are going to be in demand in the future. And there are a number of programs, individual programs going on to help do that. But I think as a country, we should spend a lot more effort in thinking about what are the right ways of doing that in a broader sense. Because productivity growth, of course, is dependent on skill sets, labor.
Loretta, let me quickly ask you this. At just 36%, the market pricing for a March hike, would you be comfortable moving next month?
So again, I think that the market is always going to have some probability of what they think the Fed's going to do. Our job is to be as transparent about the rationale for our policy path. We certainly never want to surprise the markets, but I think most people, when they're thinking about the U.S. economy, see it on a pretty good and sound footing. And so in that sense, I think our job at the Fed is to, again, base our policy on the median run outlook, be as articulate about the rationales for our decisions as we can be,